What is the most important part of the wheel option strategy? In my opinion, the most important part of any trade is trade entry. It is that decision to either make the trade or not to make the trade. And if you do decide to take the trade, what are you basing that decision on? Are you basing that on objective facts and quantifiable metrics, real numbers? Or are you basing that on subjective opinion and wild-ass guessing? I'm going to go over my thought process when I'm putting on new trades using the wheel option strategy, and it's not hard or complicated to understand. Typically, I make my trading decisions really in just a few seconds. Rarely do I spend longer than 1 minute deciding to make a trade or not to make a trade. Trade entry for the wheel strategy. Make decisions in under a minute. I've made a couple of previous videos about the wheel strategy, more in-depth videos about the wheel strategy, but today we really want to focus on trade entry, how to decide whether an underlying stock is worth running the wheel on or not. So the wheel strategy, if you haven't watched my previous videos, do check those videos. I'll try to link those in the description below. But the wheel strategy is a powerful option strategy that is a system of selling cash secured puts and covered calls. So to start the wheel, we begin by selling cash secured puts on an underlying stock that we don't mind owning if we happen to get assigned shares. We're not trying necessarily to get assigned shares, but there's always that possibility. So it needs to be an underlying stock that if we get assigned shares, we don't mind holding those shares potentially for the long term if necessary. So once we're assigned long shares on our cash secured puts, then we proceed to the back half of the wheel. We start selling covered calls against our long shares of stock until those covered calls get assigned, and then our long shares of stock get called away. Then we start the wheel turning again by selling cash secured puts. So I've shown this slide before, but we begin the wheel selling a cash secured put, right? And if you get assigned on a short put, what happens? Well, you get put 100 shares per contract of long stock for each put. And then now that we have these long shares of stock, we start selling calls against these long shares of stock. This is called a covered call because we already own the shares if we get assigned on the call. And if we get assigned on the call, then our long shares of stock get called away. They're taken away from us, usually for a profit. And then we begin the wheel turning again by once again selling cash secured puts. Now the wheel strategy is a relatively safe option strategy, but it's not foolproof. There are dangers with it. There's dangers with every trading strategy. If you're actually trying to make any kind of reward, you do have to take some risk. And with the wheel strategy, of course, there is risk, especially at the beginning of the strategy, because honestly, trade entry is really much more important than trade exit. That really determines how successful you're going to be as a trader is the entry point, not necessarily the exit point. And of course, with the wheel, when we're talking about the entry point, we're talking about this right here, selling cash secured puts on stocks that we don't mind owning for the long term if we happen to get assigned. So let's talk about trade entry for cash secured puts. Now, I've already mentioned I rarely spend more than 1 minute or so deciding if an underlying stock is suitable for selling a cash secured put on. So first, I check liquidity. If it isn't liquid, forget it, right? That's the number one rule. If it's not liquid, forget about any other metrics that you want to check. They don't matter. If it's not liquid, you can't trade it. If it's liquid, then we'll move on to checking other metrics such as IVR and IV percentage. And when we're selling options such as selling puts to start the wheel, we want high IV, right? We want IV rank, IVR, to at least be above 30. Ideally, we would like it to be above 50, but it needs to be at least above 30 because if it's below 30, then IVR is really on the lower end of its range, and those premiums for selling that put just aren't going to be as juicy. So why sell a put on a stock that's not giving me a juicy premium? Because there's so many thousands of stocks out there I could sell puts on. Go look for something with better IV. If you find an IVR below 30, chances are there's better opportunities elsewhere. I will sometimes also look at the actual IV percentage number, the IVX number that's at the top of the options chain. I want to know how likely that underlying is to make a big move or a small move, especially if it's a stock I don't normally trade. That's typically when I look at IVX. If I'm looking at a new ticker symbol that a company I don't know anything about, I don't know what sector it's in. For example, is it in the tech sector? If it is, then that IVX number is probably going to be quite high because that stock will tend to make larger moves. If it's a financial stock or it's a utility stock, that IVX number is going to be quite low because stocks in those sectors typically don't make very big moves. So IVX, I'll look at that to also gauge how likely that underlying is to make a really big move or, smaller moves. And these first two bullet points, liquidity and IVR/IVX, these literally just take a couple of seconds to determine whether something is worth trading or not. So if I go over to the TASTYTRADE platform, let me go over to one of my watch lists here. We'll go to Tasty Fast Movers, and the markets are closed. I'm actually recording this on the weekend, but let's imagine I want to trade a particular stock. How about Enphase Energy, ENPH? Now, is this a liquid underlying or not? I have traded Enphase many times in the past. I actually know Enphase is a liquid product, but if you didn't know, how would you determine if it's liquid or not? Well, the first thing you would determine is how many shares of that stock, the underlying stock, have traded. If it hasn't traded at least a few million shares, that's probably a bad sign. The stock probably isn't liquid. You could also check the options chain. Does it have weekly options? If it does, that's a sign of a more popular option trading product, which means there's more liquidity typically. If it only has monthly options, there's no weekly options, so these darker blue options chains won't be here if it only has monthly options. So if it has weekly options, that's also a good sign. Also on the TASTYTRADE platform, they give you this liquidity star meter, and if anything has 3 stars, it's okay to trade. Enphase has 3 stars, that's fine. 4 stars is even better, but if it only has 2 stars or below, it's probably not very liquid. The other thing you could do is just go to the options chain and check the options volume and the options open interest. So here for the April monthly cycle, you can see there are thousands of contracts being traded on some of the near the at the money options, and even going further out of the money, we still have a few hundred contracts trading on some of these strikes. So this is fine. Enphase is definitely liquid enough to trade. And again, I can just spot that within a few seconds if it's an underlying I never trade. If it's an underlying I trade all the time, I don't really need to check liquidity because I already know, for example, Enphase, because I've traded it many dozens of times in the past, I know it's a liquid product. The next thing I would decide, before selling a cash secured put and starting the wheel is Enphase, does it have high IV rank? What is the IVR? Remember, I want a minimum of 30. I would like 50 or above. Well, where does Enphase rank? Well, its IVR is here at the top, and you can see 38.2 is the IV rank. That's okay, that's pretty good IV rank. So already liquidity and IV rank are good. If I wanted to check the IV percentage, I know Enphase is a very volatile stock, so IVX is going to be quite high. You can see 61.7% for the April monthly option. So this thing really moves around. So options premium should be really good on Enphase Energy. I can probably go way out of the money and still get pretty decent premiums. For example, it's currently trading at nearly $130. I could go out to the 100 put and still collect $1.22 credit, right? With a buying power reduction of only $1,000. So that is very good premium for not a lot of buying power reduction. So that is a really good sign. But before I get to just automatically selling a put just because it's liquid and has high IVR, there's a couple of other things I want to check. So the third thing I want to check after liquidity and after IVR, let's actually check the chart, because if we're running the wheel, we are prepared potentially to take assignment on that put if we get a sign. So I really want to take a look at the chart. So let's go ahead and take a look at the stock chart for Enphase Energy. And is it mostly going down or is it mostly going up? Well, here you can see in the last year or so, it's mostly went down, especially from January of last year all the way to the beginning of this year. Well, it kind of turned around in November of 2023, but then it turned around here in the last, I would say 3 months, 4 months. It's kind of been a bit on an uptrend or trading sideways a little bit. It doesn't look too bearish to me though, so I would be okay potentially selling a put and running the wheel on that. It's not the greatest looking chart, but for me, that one would be okay. I would prefer to see a chart that looked a little better. For example, if I went to, maybe I check out Qualcomm here, QCOM, right? And its IV rank is actually 49.3. So that's even better IV rank. I already know Qualcomm is liquid. I've checked it before. But again, if you wanted to check the liquidity meter on TASTYTRADE, it's 3 out of 4 stars, which is pretty decent. You can see it has weekly options. It sold 11 million shares of stock on its last trading session. And if you go to open interest, you can see thousands of contracts. Actually, much more open interest on Qualcomm than Enphase Energy. So this one might be an even better one. But let's take a look at the stock chart. Oh my goodness, look at this stock chart. So it has gone from $104 to nearly $175 in the span of like 4 months. Look at that up move. Now, if you're a contrarian, you might be wary of selling a put on this thing, because when you see something that has a move up like that, you're thinking, well, it could come crashing down. Well, keep in mind, you also don't want to sell something where the stock chart looks exactly the opposite, where it's going nothing but down. For me, I would prefer a stock that's going up than going down. So yeah, I would probably choose Qualcomm. Actually, I probably would sell puts on both Qualcomm and Enphase, because they really check the boxes. They check liquidity, IVR. Both stock charts look reasonable to me. And then the fourth thing I will check, expected move. And then I'm going to choose my delta and my probability of profit. That'll be a personal choice for me. It'll be a personal choice for you as far as what percentage of a win rate you want to take. So let's go check the expected move. So if I go back to Qualcomm's chart here, let's go to the options chain. Let's go to the April monthly cycle. So let's talk about expected move. Expected move is the number on the options chain here on TASTYTRADE, as well as Thinkorswim. I've used Thinkorswim in the past. The options chain out to the side on each option cycle, you have the IVX, the IV index, and you also have the expected move. For example, the April options chain plus minus 1240. That is the expected move for Qualcomm in the 40 DTE cycle. It's expected to move $12.40 in either direction, up or down. And you can see they have this colored section here on the chain, this brown ruler. That is the expected move. So it's $12.40 up, $12.40 down. So this area here, what expected move is, Qualcomm is expected to be in that range 68% of the time. 32% of the time, it will move outside of that range, because expected move, nothing is ever guaranteed. You can't, with 100% accuracy, ever say something's going to fall within this particular range. Expected move, it's 68% of the time is what expected move is. When I'm selling my puts, I like to sell my puts either just inside the range or just outside. I like to be on the edge of the expected moves range. So first, I choose a delta. For me, I like choosing 16 to 30 deltas. I'll go out to 16 first if I can get a decent credit. So the 155 strike here is the 17 delta, and I can get a credit of $1.64 on a buying power reduction of $1,800. That's not bad. So that's actually a pretty decent return on capital for me. I would be quite comfortable selling that 17 delta put. If I wanted to be a little more aggressive, I could go up to the 160 strike, the 26 delta put. I can collect a credit of $273 on a buying power reduction of $2,300, but now my win rate comes down to 75%. You can see my pop, my probability of profit on the 26 delta put is 75%, where on the 17%, I receive less credit, but now I have an 81% probability of profit. Now, which one you choose, that'll be up to you. For me, I typically go out a little further if I can. Some people will go up further. Some people might go all the way up to the 36 delta put. This is a little too aggressive for me, but some people will do that, especially if you don't mind being assigned the shares of stock anyway, then you can get quite aggressive with your puts. For me, I'm going to go back out to the 17 delta. So everything looks good. Liquidity, IVR, I can get a decent credit for the delta that I like to hang out at. You know, probability of profit looks good. And then the last bullet point was fifth, check the buying power requirement. Buying power requirement looked good. I was going to receive $160 something for a buying power reduction of $1,800. Max loss, max reward, if you want to check that as well. The max profit is always the credit received on a short option. So the most I can make is $164. What's the most I can lose? Well, if this stock goes from 155 all the way to zero, the max loss is $15,000. Now, that is such an unlikely event. That's not really what you should consider your max loss. A better gauge of your max loss is actually the buying power reduction. The reason your broker has you set aside $1,800 for the trade for the buying power reduction is because that's what the broker is calculating as a realistic max loss. They think this trade, if it goes against you, you could lose potentially $1,854. That's why your broker has that buying power reduction. So this is really more of a realistic max loss number. So, all of this might have sounded complicated, me talking through it slowly, but really this just takes a few seconds to go through this. So this is one of the things I've made countless thousands of options trades, tens of thousands. It was one of those things, once you get into options trading, if you're very active, you can easily make tens of thousands of options trades in a year. Like some people do that. I don't. I only make about 2,000 to 3,000 a year. But you could potentially trade hundreds of thousands of options trades in your trading career. And if you make that many trades, it's not like you're going to spend 10 minutes, 30 minutes on each trade and deciding what to do. No. It's going to speed up much more quickly, right? You're not going to overcomplicate the decision-making process when you're trading that actively. For one thing, you're not going to do anything that takes a long time. We're not going to worry about fundamental analysis, checking balance sheets and income statements and all of that crap, because that's not useful at all, because we're not long-term investors, right? We're short-term investors. We're typically only in trades for a few days to a few weeks. So fundamental analysis really doesn't play at all. Also, you really don't want to rely too much on technical analysis because it's entirely subjective and it offers really no real insight into what a stock might do in the future. Technical analysis can't predict the future. It's really akin to reading tarot cards, right? And if you stare at technical indicators and things like that long enough, chart patterns, you'll come up with your own conclusions based on your own biases. So technical analysis really, because it's subjective, isn't that great. We want objective facts. We want quantifiable metrics that are easily interpreted. And that's why we use things like liquidity, IVR, expected move, POP, buying power reduction, return on capital. It's because these are quantifiable metrics. These are real numbers that are there on the trading chart. You can look at them. IVR right there, IVX right there. When you're entering the trade, you can see the POP, right? You can see the P50, the percentage of making 50% of your profit. You can see the max profit, the max loss, the buying power reduction. It's all there. Those are real world numbers, hard, tangible facts, and I can immediately tell you whether I like those numbers or not within just a couple of seconds. So let me clear out this trade here on Qualcomm. I'll just do another example real quick on something I haven't taken a look at. How about TXN? Is that Texas Instruments? I've never traded Texas Instruments, but I know it's a popular stock that a lot of people do trade. You can see 5.63 million shares were traded of the underlying stock, so that seems pretty liquid to me. If I check the liquidity meter, 3 of 4 stars on TASTYTRADE. And you can see it has weekly options. So there's several weekly options chains available. That also means that it probably trades quite a bit of options volume. If I go to the April monthly options cycle and look at open interest, again, a few thousand contracts are open on many of these strikes. So this seems quite liquid to me. You can check the bid-ask spread on the options, and you can see the bid-ask spread here at the money puts, 15 cents wide, going out one more strike. That's 11 cents wide. So about 10 to 15 cents wide for the bid-ask spread. That's reasonable, especially since the stock is a high-price stock, $172. So that's not too bad. I would trade Texas Instruments, or I would have no problem trading it. Again, I've never traded it, but IV rank 46 looks good. Liquidity looks good. So the next thing I would do, I would pick a delta that I'm comfortable with. The 18 delta put, I can sell that for a $1.42 credit. The buying power reduction is $2,200. So I receive $140. I have to set aside $2,200 for buying power reduction. That's not terrible. And my
Probability of profit on the trade, it says I have a 92% on the 18 delta. That really should be a 82%. So, but this is the weekend, so some of these numbers may be a little funky because the markets aren't open and the options obviously on these are not trading right now. So that probability of profit number probably should be around at 82%, but let's assume it's 82%. Max profits 142, buying power reductions $2,200, IV ranks 46, liquidity looks good. Yeah, I would just go ahead and ship that. And that would take me all of about 30 seconds or so to decide. So with enough experience, you can determine if a trade is a good trade or a bad trade within just a few seconds. And again, don't make things harder than they need to be. Simplify your trading, right? The thing with trading, a lot of people try to make it overly complicated. They try to add all of this stuff, all these technical indicators and fundamental analysis and technical analysis, and they're drawing patterns on charts, and they're really staring hard at charts every second of every day, and it's not that complicated. It doesn't need to be that complicated. If you're making something more complicated than it needs to be, typically you're doing more harm than you're doing good. So hopefully this video cleared up some of the confusion as far as how to arrive at a trading decision. For those of you that want to learn more about this topic, as well as just a general book on the wheel option strategy, check out my book, The Super Wheel Option Strategy, available on Amazon. There will be a link in the description below. And if you guys want future videos about other wheel related topics, for example, we just covered trade entry. What about trade exit? What about managing a trade? What about a trade that's neither losing for you, but it's not necessarily winning? What about rolling these trades? You know, if you want videos on some of these topics, let me know in the comments down below. Peace, guys.